You have become increasingly outspoken on the prospects for growth and for prosperity under this presidency. Why?
Well, I think our economy, and in fact the global economy, because of it's finance-based, more finance-based, credit-based now than ever, that the economy has turned into a system where money makes money as opposed to money or credit leading to capital investment as an old-fashioned capitalism. Keynes had a phrase about casino-like conditions, leading to an ill-done result. And I think the possibility now is taking place because money is making money, but not leading to real economy investment.
Is that situation not correcting itself at least a little bit with interest rates rising, albeit in very small increments, and the talk of the unwind of the Fed's balance sheet, no matter how skeptical some in the room might be about that prospect?
Yeah, I think a little bit, and I think the Fed, as the global central banker, is perhaps aware of the potential negatives of low interest rates. But I think longer-term secular forces, and these are forces that are subjective to a certain extent, but demographics and high levels of debt, deglobalization as opposed to globalization, and the degradation of labor from robots and so on. All of these are factors that lead to slower growth as opposed to faster growth, because if you reverse them, globalization, accumulation of debt, et cetera, those were conditions over the past 20, 30, 40 years that have led to extraordinary growth or above average growth, and now we're below that type of.
So you posed this question in your latest investment outlook. You say, can the Trump agenda recreate 3% growth?
Right.
And you conclude with this quote: high rates of growth and the productivity that drives it are likely distant memories from a bygone era. So you've explained part of that. Let's finish the explanation. Why are they memories of a bygone era?
Well, I think in part because of those secular factors. I think productivity, to a certain extent, was a function of finance. I mean, when we go way back in terms of mortgages and securitization and so on, leading to access to housing and so on, you can see a certain element of productivity in finance itself. As a matter of fact, some papers have talked about maybe 0.5% over a period of time. And now with finance played out and interest rates as low as they can go in many countries at least, and productivity there is certainly changing. And then there's the Gordon thesis of low-hanging fruit and so on. But
Robert Gordon, the economist from Northwestern.
From Northwestern. But the counter is simply that it takes a long time for technology to affect productivity, certainly in medicine and other areas, and so let's wait and see. But we have seen productivity in the U.S. at a flat line basically for the last 5 years, and that's becoming a long-term trend. And I think the secular forces of debt and demography. Older people do not demand as much in terms of goods and services. Healthcare, yes, but they slowed down an economy simply because society is getting older. You see that in Japan. Look at Japan as a petri dish for the last 10 or 20 years, and not all of the factors are the same with immigration and so on, but to the extent that the global developed world is aging, then that presents a problem for capitalism and for growth.
So that's a commentary more on structural reality than it is a criticism, if you will, or at the very least skepticism of what this administration and this president might accomplish.
Yeah, I think so. And when you speak to the administration, you speak to fiscal policy and potentially monetary policy with the appointment of governors and presidents and ultimately the head of the Fed in a few years. But I don't necessarily criticize monetary policy. It's done what it's had to do. But I think at a certain point they crossed the line and went too low, even into negative territory. And I think ultimately that low interest rates and negative interest rates have a very destructive force in terms of capitalism, because certain business models, long-term established business models like insurance companies, pension funds, even banks to a certain extent, have liabilities that require a return on investment and a return on their savings. Even mom and pop in Des Moines require a certain interest rate to pay for education for their kids or for retirement or for health care. And to the extent that savings doesn't provide an attractive return because of low interest rates, then a balanced capitalistic economy becomes potential to misfunction.
I've been an observer of finance for some time, not as long as you. I remember as a college student hearing about what the mortgage bond market was doing for housing. And I've seen financial innovation, good and bad, come and go as you have. What do you mean by finances played out? Is that to say that that good ideas? I don't know what they mean. Tell me, because I'm thinking it could be all the smart people are going to Silicon Valley. It could be the financial regulation has stamped out innovation. It could mean something else.
Well, innovation is changing finance and changing investment, certainly with algorithms and the substitution of a machine for a person. There's no doubt about that. But when I say that finance is played out, I simply mean that the price of credit is basically as low as it can go. And common sense and economic models would suggest, as central banks have suggested for decades, that the lower the interest rate, the greater the push in terms of economic growth as capital markets appreciate, and the trickle down wealth effect leads to an element of growth. But when interest rates get so low, then things may go into reverse. Money may go into a mattress as opposed to an investment. And certainly if you were an investor in Germany or a saver in Germany with the ability to hold euros as opposed to put it in a bank and be assessed 50 basis points, you would see the beginning of the reversal of the process where lower interest rates in finance plays out and begins to move in a direction that is negative as opposed to positive.
So we all know that optimism is pretty irrepressible. Why do you think it is, though, that more people don't share this harshly realistic view of the future?
Well, I think it pays to be optimistic. I remember a phrase by Bernard Baruch back in the late 20s, early 30s. He was part of the FDR administration, and he said 2 + 2 always equals 4, and you can't keep mankind down for long. Humankind these days. But yeah, optimism is an essential force of capitalism, risk-taking, hope going forward, much like on the golf course. Golf is a function of hope, a hope that the next shot will be better than the last. And so, to the extent that, hope is an essential element of human psychology, I think it always will be. And so I wouldn't denigrate that particular psychology of human nature, but I would say that it's now confronted with secular forces to some extent of human nature's own doing, not having enough babies, taking on too much debt relative to what they could service and afford, producing policies, potential policies that deglobalize as opposed to continue globalization. And so, human mistakes and policy mistakes can counter, that essential element of hope that forms the basis of capitalism.
So what you articulate has implications, clearly, for financial markets and how investors should behave and view things like treasury yields at current levels or credit spreads, which you've already mentioned, equity valuations. What are you thinking about those? What are you thinking about the state of the market today and how it's likely to evolve given what you see as the undeniable future for the economy?
Well, if we're talking investment markets, it's hard. It's obvious that it's hard for money to make money. And I start back in Euroland and Germany and France and even Japan, where obviously if you hold a 5-year shots that you wind up with 2.5% less than where you started. And
you're paying them, they're not paying you.
Yeah. You move up the line, and yes, the 10-year treasuries yield 2.15, and that's something. Um, but
Not a lot.
not a lot. And it's incredible when you look at the swaps market, which isn't as well advertised, but a 30-year swap basically yields 235 or 240, and on the other side where you pay, you're paying 125. So if you receive a swap or you buy a swap, basically you're getting a return of 1.25% for close to a 30-year durational risk. 5 basis points could wipe out your annual income in one day. And so all of these things begin to tell you that in the bond market, that future returns are going to be very narrow, if not preceded by a negative sign. And as we move on up the line, yeah, it's harder to analyze stocks, certainly the technology stocks, because there is a growth element, and in many cases, a substantial growth element to some of these companies. But they're all connected, like the hip bone to the thigh bone, et cetera, and discounted, I think, via either dividend discount models, the Gordon model, et cetera. But there's a connection. And so, when you see tight corporate spreads and high yield spreads and, PEs that I guess in the Shiller basis are at relatively high levels, you simply have to know that absent the growth that, Trump is trumpeting, that, perhaps low returns are the thing of the future.
Of all the things that you evaluate on a daily basis, and I'm talking about securities and assets, classes, that is, what seems most rational right now? What's most rationally priced? What's most irrationally priced?
Well, in the bond market, I would say treasuries, although it's not highly rational, but relative to other developed countries. In the UK, for instance, the 10-year is less than 1%. Japan, 10 basis points. Germany, 25 basis points. So treasuries are a bargain from that standpoint, a relative bargain. What else? I think if you wanted to go into the minute details, I think that, there's certain closed-end funds that sell at discounts, 5 and 10% discounts to net asset value, that are levered to some extent, and leverage with a low-yielding Fed and a low-yielding Fed funds rate it's always at risk, but not necessarily as much as when the Fed was going to be raising interest rates. And so, various closed-end funds which yield 5, 6, 7% on the municipal side, and 7, 8, 9, 10% on the corporate side. I think those are attractive.
And these are the kinds of things that you now, as manager of the Janus Global Unconstrained, are looking at versus what people here might think of as Bill Gross doing, which is treasuries and mortgage-backed securities for the most part.
Yeah, for sure. And to some extent, I think, well, there's 4 ways to earn beta or even alpha if done well. You can take credit risk, you can take duration risk, you can take liquidity risk, or you can take volatility risk, better expressed with the VIX. But all of these elements of beta and potential alpha generation are compressed and therefore very expensive. I still think that volatility, which is something we're doing with Janus Unconstrained, the sale of volatility, while volatility is very low, we know the VIX, we know the MOVE index says the same thing about bonds. It will probably continue to be low until other central banks, the ECB and the BOJ, get on the march and start on the move, and that may be, 6 to 12 months away. So the sale of volatility can turn a 10-year treasury of 2.15% into a 5 or 6% investment, given a range-bound world, and we've seen that for a long time. For the last 2, 3, 4 years, real interest rates have been moving, but in a range. And
so you like that trade, which is to say, what, that you see it coming back into vogue 6 to 12 months from now?
Well, I think the carry trade, as everyone knows, and the carry trade involves either credit or duration extension or liquidity to illiquidity, or the sale of volatility. It has been in vogue for a while, and justifiably so over the last 6 to 12 months. The last few days, things are sort of moving. But if things don't move that much, if the Dow and the S&P just sit there, and then they have for certain inexplicable reasons, I suppose, but then the sale of volatility works. When something happens, when a taper tantrum develops, and it certainly can develop, not just in the U.S., but in foreign developed markets, then you want to be on the other side. In other words, you want to give up carry. That, investing depends on accepting carry in the right areas. But in some cases, and we're talking bear market, the absence of carry or the sale of carry, it is the way to go.
What's the other side of the carry trade look like?
Well, it's not very expensive. I mean, the other side of the carry trade in option land is to buy a put or buy a call. That's very cheap.
No, what I'm thinking of more of is what does this world look like when investors can no longer rely on carry as the...
It's not good, because capitalism depends on carry and an extension of duration or risk in order to promote growth. If everybody had their money in the bank and the bank had their money in the central bank, then credit couldn't expand. And so, yeah, it's a world that is restrictive in terms of forward-looking growth, and that's not good. To a certain extent, I'm saying that the credit cycle, because of the extension of debt and the lowering of interest rates, has largely been played out, and we need another act or another system to revigorate.
You made reference earlier, Bill, to passives and to machines. It's a different world than it was when you started at Pacific Mutual Life in '71 or when you started the Total Return Fund in '87. How have you had to, share with us if you wouldn't mind, how have you had to adapt and evolve as a manager, as a thinker, and how do you see yourself, because I know you're not about to hang up the high tops, continue to adapt and to evolve?
Well, I think the adaptation at PIMCO was done with a secular type of view, a longer-term view, 3 to 5 years, not a futuristic type of outlook, because only Jules Verne types could do that. But I think you have to look forward by a few years, either in technology with robotization or with the debt, the situation in demographics, and try and analyze, necessarily without a model, just commonsensically, where and when these factors will begin to affect markets. Same thing with globalization. Globalization's a tough one, and I would admit that Trump backing out of the Paris Accord, may or may not have much effect in terms of policies, because Governor Brown in California and others are moving in the opposite direction. But still, global warming, and that's one of Michael's main themes, and mine too. I'm a believer. Ultimately, produces a liability on the part of economies and global societies as they eventually move to.
How do you know when these things begin to affect asset prices?
And that's the problem, the timing. Because as an asset manager, you can sit there and be a believer and ultimately be correct. But in the 2 or 3 or 4 or 5 year time period where you're sitting on your hands, you're out of clients. And it's much like, the Citigroup chairman who said you got to keep dancing. You do have to.
Prince.
Yeah, and Chuck was sort of right, although he said it at the wrong time. He said it when the music stopped, as opposed to as it was continuing. But yeah, you do have to keep dancing. It's the same thing at the country club. They say, well, what else are you going to do with your money? And it's a perfect question, because you can't get rich, nor can you pay for your bills at 0.5%.
So how does that affect you? How are you, if you will, still dancing in a way that feels a little uncomfortable, because it's at odds with what you believe at some point in the future will happen.
Well, you don't dance the Lindy or I don't know what the modern version is, but you sort of waltz and you're still on the floor, but you do it at a slower pace, meaning less risk and the acceptance of lower return. What I tell our clients is simply the halcyon days of double digits are over, and our target of 4 to 5% returns with very low volatility is what an investor should accept. Now that's hard with a stock market up 10, 15%, since November. It's hard to make that sale, but I think it's a valid one.
So is that the most challenging or confounding question you're trying to answer for yourself right now, or is it something else? What would be at the top of the list?
No, I think the timing of that, because there are other factors, and we know about geopolitical problems with North Korea and so on. Something could happen at any time. It always could, but it seems like it's even more possible these days. And so when you have low volatility, when you have tight spreads, when you have high PEs, when you have low interest rates, something could happen at any time. And yeah, the timing, but yet the waiting in terms of accepting a lower return and waltzing on the dance floor, or if if you talk about it in terms of musical chairs, sort of hanging around that empty chair so that you don't miss out when the music stops.
So your level of risk aversion or caution, if you prefer, is most like what other point in time since 1971?
Well, it's not as much as pre-Lehman, and PIMCO did very well pre-Lehman in terms of anticipating the crisis.
And post-Lehman.
Yeah, that's how we went from $1 to $2 trillion. We got it right. We weren't part of the big short, but we were part of the big void, so to speak, in terms of subprimes. So that was the most crisis-laden environment in which the Minsky moment was upon us, and Paul McCulley at PIMCO guided us very well in that direction. But now I think it's second, simply because of these secular forces that are coming together.
You feel the second most risk averse today than you have over the course.
Yeah, if only because financial markets are telling you that there's not much reward. It's obvious in the bond market with negative yields that I've talked about, but it's not so obvious in risk markets and growth-oriented markets, certainly with some of the high-flying stocks, but they're all connected, and so just an acceptance of that would suggest that the return is going to be much lower and the risk much higher.
To earn that return.
Yeah, it's not an attractive situation. Instead of buying low and selling high, you're buying high and crossing your fingers.
Bill, on that optimistic note, I'd like to thank you very much for joining us here at Bloomberg Invest. Ladies and gentlemen, Bill Gross.
Thank you.